silver has done this before, and when it has done this before, it's always crashed. And the chances that it will again are pretty high. Crash to what? I don't know. Silver could do anything.
Silver concentrate, which has largely been pulled by China for the last 5 years, is no longer going there. And at the same time, Chinese nationals are going into Latin America looking for finished silver. This is what's going on. Maybe the US and China aren't handling it. Maybe they're not talking, but somebody is sourcing silver to cover shorts into the US. That's either for physical demand domestically, it's for Chinese demand, foreign demand that's coming through the US, or it's from a bank, maybe someone as big as HSBC, who knows, that's just getting carried out on the stretcher because they couldn't extend and pretend anymore. This is a sign of a blow off top.
Silver has reached a familiar and dangerous phase of its cycle. Historically, when silver accelerates this fast, it rarely stabilizes quietly. These sharp vertical moves have often ended in violent reversals, not because the long-term story breaks, but because speculative pressure overwhelms the market structure. Rafi Farber and Vince Lanci point out that today's move has unusual fingerprints. Chinese buyers have largely stopped taking silver concentrate, while Chinese nationals are actively sourcing finished silver across Latin America. At the same time, physical metal appears to be moving into the US, potentially to meet delivery needs or cover stressed short positions. Whether this demand is industrial, sovereign, or tied to large banks unable to roll paper exposure, the result is the same: intense short-term strain. This behavior aligns with classic blow-off dynamics: tight supply, forced buying, and emotional price action. That doesn't end the bull market, but it often marks a temporary peak before a sharp reset. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Similar magnitude to 2011 silver rally versus gold. One of the reasons that I would grow cautious here, and we could see silver do anything over the next few days. These two lines over here are an equal sign. See, I did it myself with paint. I'm an artist. That's what they call me. We have here the gold to silver ratio. You can see that this rectangle is the same length as this rectangle, right? I drew them myself, so I know. And we have here the similar magnitude in the silver rally from 2008, right? The end of 2008. That's when we last saw silver over here at about 85. That was the 2008 financial crisis, the worst of it over here. And then down into 2011 when we hit about 30-to-1 ratio. So from the peak of the financial crisis, September 2008, to May 2011, what was that? Like 2.5 years. So silver, the gold to silver ratio went from 85, a high of 85, to a low of 30. That's a move of 55, right? 30 plus 55 is 85. We have here a very similar magnitude. The gold to silver ratio is now at about 60. It was at a high of 105, so that's a move of 45 as opposed to a move of 55. So not exactly equal. I was wrong about the equality. It's not equal. I was lying. Oh well. But it's a similar magnitude, so we got to be careful, and we've broken the resistance here at about 63, 62, whatever that is. Just be careful here. Don't expect silver to keep exploding day after day after day. There's going to be some shakeouts. They're going to be extreme. Be careful, be conscious, and don't listen to everything that you hear on social media. Now, given that the gold to silver ratio is starting to a bit normalize, the silver to stocks ratio is not even close to that. We're still at 0.011 here of the silver to S&P 500 ratio. We are nowhere near where we were in 2011, which was about 0.04, let's just estimate. So we have about a 4 times rally. If silver quadrupled here relative to the S&P, whether that's because the S&P gets cut by 75% or silver quadruples or some combination, we still have a long way to go in terms of the purchasing power of silver. $80 is really not much compared to what stocks have been doing since 2011. It's not even close. And here is the most shocking chart you'll see. Remember that 2011 huge bump to 0.04? That was this tiny little thing over here. But compared to 1980, we're still nowhere near anything of where silver was relative to stocks. The purchasing power of silver relative to stocks in 1980, nothing. You can barely see this little uptick over here where we are now. So yeah, in terms of end game moves, there's a long way to go here. Don't even think that the rally is done yet. It could get wild here, so I would stay out of leverage instead of options instead of leveraged funds. But still, in terms of the longer term, in the longer term, I would only define as like a year or two from now, because like after that, the dollar's going to be dead anyway. So over that time frame, silver's going to go way up here, and just be ready for that, but be ready for some crazy action now. The London silver spot premium returns. Remember when we were in the what people were calling backwardation in silver, what I was calling a premium in London spot over New York futures, which is not exactly backwardation, because backwardation would be New York silver now more expensive than New York silver later, which is not the case here. But this does show a backwardation of sorts, even though I wouldn't call it technically backwardation. We're back to a $2 premium of London spot silver over New York futures. So that did portend or predict a move to 50 back here. Look at this tiny little move to 50. It's like a little baby move to 50. But here now we're at 80, and I think we're at 75. It's going to get crazy. It's already crazy. So it's now that we're back to this London premium. London is showing another shortage. They're going to have to get another influx of silver, probably from New York, and that is probably going to drive prices even higher with volatility. Yes. So platinum, check out platinum, which of course means little silver. I was talking about this. I've been talking about this on a few silver reports now and then, of the mother of all triangles in platinum. Well, that triangle just broke out in a big, big way. We have here the triangle going all the way back to 2004, hit the bottom in 2008 financial crisis. After seeing this, this was showing like an inflationary crisis in early 2008. So we could be seeing that over here. That's probably what this is. It's the beginning of an inflationary crisis, which will cause a hyper deflationary crash, which will cause the Fed to panic and print a whole bunch of trillions of blah, blah, blahs. And then we'll see the end game. I mean the end game. It'll be it. That'll be it. But this huge triangle has been narrowing down until the beginning of this year, or the middle of this year even. And this breakout is the mother of all triangle breakouts. I've never seen anything this extreme, but it does not surprise me. I have been saying that if you want a little bit of platinum, it's been a good time to get over the last few years, last few months especially. The platinum to silver ratio is still actually pretty low. I think it's like 35 now, still historically low, but it was down to like 26 or something. So platinum, I only have a few ounces. You can get a few ounces to save some room if you want. It's a very volatile metal. Anyway, compared to stocks, though, if we look at platinum versus stocks, it's similar to looking at silver versus stocks versus silver to gold, or the silver price itself. This is the platinum rally versus stocks. Okay, you can see there's a quite respectable candle here, but compared to where platinum was in 2011, 2008, 2011, and historically, this is nothing. Platinum still has a long way to go versus stocks, meaning it's stocks, mainstream stocks, that have really gone crazy the last few years, the last few decades even. The metals, what they're doing now is just the beginning of the catch-up phase, just the beginning. Be careful. Don't trust all these social media rumors, and know that there is some stuff going on in China specifically about silver funds there, where some funds have shut down because investors are backing up the truck on silver funds, and the fund managers can't accommodate all the investments, so they're actually shutting down, which is, I see, a warning sign. And COMEX has actually pushed up margin requirements. We'll see what that does for silver futures this week, and we'll see if they keep doing it. This is not a very big raise.
Silver is now moving with a magnitude that closely mirrors the 2011 rally relative to gold, which is why caution is warranted in the near term. The gold-silver ratio has already fallen sharply from above 100 toward the low 60s, a move comparable in scale to the post-2008 surge that preceded extreme volatility. That does not mean the move is over, but it does suggest that daily, uninterrupted upside is unlikely. At the same time, silver's purchasing power versus stocks remains far below historic peaks. Even at current prices, silver is nowhere near its 2011 or 1980 extremes relative to the S&P 500, implying substantial long-term upside once the current turbulence resolves. Adding to the tension, London spot silver is trading at a premium to New York futures again, signaling renewed physical tightness. Expect sharp shakeouts, elevated volatility, and sudden reversals, but also recognize this may still be an early phase of a much larger realignment. Let's get back to the interview.
There's your daily chart. What you're looking at on the left is US, I want you to think of it as Western Hemisphere silver and Eastern Hemisphere silver. Okay. What you'll see is that the high in silver in the West was 83.75 spot. The high in futures in the East was, this is rounded, right? So we'll call it 89. All right. So let's call that 84 and 89. That's a spread of $5. So on the very tippy top highs in both contracts, the spread went from $8 to $5. And that's because someone in London got their ass handed to them, or someone who needs to buy physical and London couldn't provide it, got their ass handed to them, and they had to chase the physical up. Could have been a tech company that said, oh shit, I need my silver. Could have been China saying, oh shit, I need my silver because, remember, as I said, restriction on exports is really a mandate to import. It could have been someone in the US that had a desk that was blowing up. But I think the most obvious thing is when you have American bullion banks sourcing metal from Latin America, pulling it to the US, and you have Chinese shorts covering on their own exchange, while JP Morgan is pulling metal out of restricted into eligible, you have a situation where you have multiple shorts and they're tripping over each other. And you have a real demand for silver, which brings me to the point that I made earlier in the week or later last week. And that is the US geopolitically is shutting China out of the Americas. I'm not alone in this opinion, right? Eric Young and I have talked about it. We've noted Venezuela. He noted Venezuelan oil goes to China, okay? We've noted that silver concentrate, which has largely been pulled by China for the last 5 years, is no longer going there. And at the same time, Chinese nationals are going into Latin America looking for finished silver. This is what's going on. Maybe the US and China aren't handling it. Maybe they're not talking, but somebody is sourcing silver to cover shorts into the US. That's either for physical demand domestically, it's for Chinese demand, foreign demand that's coming through the US, or it's from a bank, maybe someone as big as HSBC, who knows, that's just getting carried out on the stretcher because they couldn't extend and pretend anymore. This is a sign of a blow off top, okay? Not because it's over, not because the fundamentals changed. They didn't change. There's still not enough silver. Maybe they found some scrap and it came out at that price. Maybe they had to let the market breathe just enough to shake out the nervous short. Because look, when you have two types of shorts, an industrial short, right? And then you have a bank short, who's not really that important. The industrial short can be bought off. Could you wait 30 days? Yes. I'll give you a discount. I'll give you a free toaster. I'll give you free checking. You can raise the prices on your iPhones to your customers. Can you just wait 30 days, 60 days, 90 days? And the customer says, yes, because I don't want to disrupt the market because I depend on this market and I trust my bank. The rogue player, that's what he's going to be called, right? The rogue player, the guy who's short, kept rolling his shorts, kept deferring his losses, kept borrowing from the Fed window, right? That short is probably been carried out on a stretcher. And at least one of them is in a body bag financially. And God forbid whoever's managing the risk on that desk. When you shake out the weak shorts, which is someone with a derivatives position, whether it's Chinese or American, I don't give a shit. It's real. And that person got stopped out. And now the market can go back to being fundamental, or at least they hope. So assume that it will be bought all the way down. Assume that it will be capped and sold up top again. And assume that this is going to go on for some time. But there will always be tightness in silver because of that. There will be selling in silver above. But now it's a matter of time. I'm an American bank, and I'm backed by the Fed, and I need to find silver. If I can't find the silver, I go and talk to my clients, and I say, please wait. Maybe it's Samsung. I say, please wait. I'll get it to you in 90 days. And then I talk to my Latin American producers, and I say, give me every fucking molecule and atom of silver you have. And then I watch what happens. And what happens is somebody gets screwed. And the people asking for the silver are the ones who got screwed. So there's your daily chart. I'll bring up the 15-minute chart. I don't know if they're synced. They're not synced, but here you go. Here's while the Western Hemisphere silver was dropping, the Eastern Hemisphere silver was rising. Okay? This is a position being unwound. Physical was getting sourced and futures were getting closed. I don't know exactly what's happening, but that is what's happening. Look, if you want to, if you want to trade this, I mean, I'm actually shooting myself in the foot here because we've picked up, a lot of subscribers, and we're here to give you insight on what to do. If you want to chase the waterfall, go for it. I'm not going to stop you. But people who know me, who have been subscribers for a long time, know that I prepare, and then afterwards we try and close and move on. Right now, I've been selling my speculative position into this rally all the way up, and I have been out for about 2 weeks. Founders, GoldFix founders also know that when gold had its, what was it, like a 8-week run, 10-week run, I was out after 7 weeks and just giggling because I could have made so much more money. The point is, I want to be able to buy the dip if I want to buy the dip. The point is, I want to be able to not be handcuffed if the market drops. So do what you want. There's been a lack of research coming out about metals now, and that usually happens when banks have orders to buy physical.
Silver's recent price action is revealing a deeper structural stress between Western and Eastern markets. Spot silver in the West peaked near the mid-80s, while Eastern futures pushed close to the high 80s, leaving a persistent premium that briefly narrowed as physical metal was aggressively chased. That compression is a tell. Someone needed real silver urgently, and paper liquidity could not meet the demand. What followed looks less like a trend reversal and more like a violent position unwind. Physical silver was sourced while futures shorts were forced to cover, creating sharp intraday divergence between regions. This kind of move often marks a temporary blow-off phase, not because fundamentals weaken, but because weak or over-levered shorts are flushed out. The bigger picture remains unchanged. Industrial demand, geopolitical sourcing pressure, and constrained supply still define the market. Volatility should be expected, dips may be sharp, and liquidity can vanish quickly. This is a market resetting under stress, not one losing relevance. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.